Question 1. Which of the following best describes the primary difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance is mandatory for the ceding company, while treaty reinsurance is optional. B. Facultative reinsurance covers a specific risk, whereas treaty reinsurance covers a portfolio of risks. C. Facultative reinsurance involves a fixed premium, while treaty reinsurance involves a variable premium. D. Facultative reinsurance is always non-proportional, while treaty reinsurance is always proportional. Answer: B. Facultative reinsurance covers a specific risk, whereas treaty reinsurance covers a portfolio of risks. Explanation: Facultative reinsurance is purchased by the ceding company for specific individual risks that exceed its retention or capacity, and it is negotiated on a case-by-case basis. On the other hand, treaty reinsurance involves a blanket agreement covering a portfolio of risks, typically with predetermined terms and conditions. The other options do not accurately describe the key distinctions. Option A is incorrect, as facultative reinsurance is not mandatory. Option C is incorrect, as the premium structure can vary in both facultative and treaty reinsurance. Option D is also incorrect, because facultative reinsurance can be proportional or non-proportional, just like treaty reinsurance. Question 2. In a quota share reinsurance agreement, which of the following is the primary responsibility of the ceding insurer? A. To absorb all claims exceeding the retention limit. B. To cede a fixed percentage of the premiums and losses to the reinsurer. C. To negotiate the pricing of the reinsurance treaty on behalf of the reinsurer. D. To provide an unlimited guarantee for the reinsurer's liabilities. Answer: B. To cede a fixed percentage of the premiums and losses to the reinsurer. Explanation: In a quota share reinsurance agreement, the ceding insurer agrees to cede a fixed percentage of both premiums and claims to the reinsurer. This method is proportional, meaning the ceding company and reinsurer share the risk, premium, and losses in proportion to the agreed-upon percentage. Option A refers to excessive loss reinsurance, not quota share. Option C is incorrect, as the reinsurer generally handles the pricing for the reinsurance contract. Option D is incorrect, because the ceding company is not required to provide an unlimited guarantee if the cession is based on the agreed-upon percentage. Question 3. Scenario-based question. Mr. Thomas, an insurance company executive, is assessing a potential reinsurance treaty. The treaty would cover a portfolio of high-risk properties located in coastal areas prone to hurricanes. Mr. Thomas is particularly concerned about the impact of large catastrophic events on the company's financial stability. He has two reinsurance options. One is proportional quota share treaty and the other non-proportional excessive loss treaty. Which option should Mr. Thomas choose to better manage the risk of major catastrophe? A. He should choose the proportional quota share treaty, because it will cover all the losses regardless of the size of the catastrophe. B. He should choose the non-proportional excessive loss treaty, because it provides protection against catastrophic events that exceed certain threshold. C. He should choose the non-proportional excessive loss treaty, because it offers higher premiums and thus higher returns. D. He should choose the proportional quota share treaty, because it predictable and consistent amount of coverage. Answer: B. He should choose the non-proportional excessive loss treaty, because it provides protection against catastrophic events that exceed a certain threshold. Explanation: In this scenario, a non-proportional excessive loss treaty would be the best choice for managing the risk of catastrophic events, such as hurricanes. This type of treaty provides protection for losses exceeding a certain predefined amount, the retention limit, making it ideal. Large-scale catastrophic risks. The proportional quota share treaty, in contrast, would share all losses in proportion to the agreed-upon percentage, making it less effective for handling catastrophic events, which may lead to large, unexpected claims. Option A is incorrect, because the quota share treaty does not specifically address catastrophic events. Option C is incorrect, as the focus should be on risk management rather than higher premiums or returns. Option D is also not the best choice, because, while predictable, the quota share treaty does not provide sufficient protection for large-scale catastrophes. Question 4. Which of the following is a key feature of a non-proportional reinsurance agreement? A. The ceding company retains a fixed percentage of all premiums and losses. B. The reinsurer only covers losses above a specified retention limit. C. The ceding company and reinsurer share premiums and losses in a fixed ratio. D. The reinsurer assumes responsibility for all the premiums of the ceding company. Answer: B. The reinsurer only covers losses above a specified retention limit. Explanation: non-proportional reinsurance, such as excessive loss, only applies when the losses exceed a certain retention limit set by the ceding company. This is different from proportional reinsurance, where the reinsurer and ceding company share both premiums and losses in a fixed ratio. Option A refers to proportional reinsurance, not non-proportional. Option C is also for proportional agreements, while option D is incorrect, as the reinsurer does not take on all premiums in non-proportional arrangements. Question 5. What does the term retrocession in reinsurance refer to? A. The process by which an insurance company offers a reinsurance policy to its policyholders. B. The process of a reinsurer transferring some or all of its risks to another reinsurer. C. The process of a reinsurance company absorbing more premiums than it can handle. D. The agreement in which a ceding company offers direct insurance policies to its customers. Answer: B. The process of a reinsurer transferring some or all of its risks to another reinsurer. Explanation: retrocession is the process by which a reinsurer transfers a portion of the risks it has assumed from the ceding insurer to another reinsurer. This process helps reinsurers manage their risk exposure and maintain financial stability. Option A refers to the direct sale of insurance policies, not reinsurance. Option C is incorrect because retrocession involves risk transfer, not absorbing excess premiums. Option D refers to the sale of direct insurance policies, not reinsurance. Question 6. Which of the following factors is least likely to influence the pricing of a reinsurance contract? A. The ceding company's loss history and claims experience. B. The reinsurer's financial strength and solvency ratio. C. The geographic location of the ceding company's risks. D. The number of policyholders insured under the ceding company's policies. Answer: D. The number of policyholders insured under the ceding company's policies. Explanation: reinsurance pricing is influenced by several key factors, including the ceding company's loss history, claims experience, financial strength, solvency ratio, and the nature of the risks being insured, such as geographic location. However, the number of policyholders is not a direct determinant of reinsurance pricing. Reinsurers focus more on overall risk exposure, loss history, and solvency rather than the number of individual policyholders. Option A, B, and C are all correct factors influencing reinsurance pricing. Question 7. Which type of reinsurance contract allows the ceding company to cede a fixed percentage of the premiums and losses from a group of policies, with the reinsurer assuming that same percentage of risk? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer: B. Quota share reinsurance. Explanation: quota share reinsurance is a proportional reinsurance arrangement where the ceding company and reinsurer agree to share premiums and losses in a fixed percentage. This means that the reinsurer assumes the same percentage of both the premiums and the risk from the ceding company's portfolio of policies. Option A refers to non-proportional reinsurance, where the reinsurer only covers losses above certain retention. Option C refers to type of proportional reinsurance that applies when losses exceed specific amount. Option D refers to facultative reinsurance, which covers specific risks rather than a group of policies. Question 8. Mr. Robertson, an insurance executive, is deciding whether to purchase a quota share reinsurance treaty. The treaty would require him to cede 30% of the premiums and losses for a portfolio of policies. If Mr. Robertson expects high claims due to increased risk exposure, what is the most significant advantage of choosing a quota share reinsurance arrangement? A. It allows him to retain more premium, which increases profits. B. It provides predictable and stable coverage in case of significant losses. C. It allows him to share all risks equally with the reinsurer, including smaller losses. D. It ensures that he will not need to pay any premiums to the reinsurer. Correct answer: B. It provides predictable and stable coverage in case of significant losses. Explanation: a quota share reinsurance arrangement provides the ceding company with a stable and predictable way of sharing both premiums and losses with the reinsurer. This predictability is important when the ceding company anticipates high claims due to increased risk exposure, as it allows for shared responsibility for both premiums and losses. Option A is incorrect because quota share reinsurance involves the ceding company transferring part of the premiums Option C is not the most significant advantage, as quota share focuses on proportionate risk sharing rather than equal distribution. Option D is incorrect because the ceding company must still pay premiums to the reinsurer for coverage. Question 9. When assessing the financial stability of a reinsurer, which of the following is most critical for a ceding company to consider? A. The reinsurer's business model and market share. B. The reinsurer's financial strength, rating, and solvency ratio. C. The reinsurer's geographic expansion plans. D. The reinsurer's advertising and branding efforts. Answer: B. The reinsurer's financial strength, rating, and solvency ratio. Explanation: Reinsurer's financial strength, rating, and solvency ratio are crucial factors in assessing its ability to meet its obligations in the event of large claims. These metrics reflect the reinsurer's financial health and its capacity to cover potential liabilities. While business model, market share, geographic expansion, and branding may contribute to the reinsurers, they are not as directly linked to the financial stability necessary to fulfill reinsurance obligations. Therefore, option B is the correct choice. Question 10. Which of the following is true about the role of the New Hampshire Department of Insurance in the reinsurance market? A. It provides direct reinsurance to ceding insurers operating in New Hampshire. B. It regulates and supervises reinsurance activities within the state to ensure compliance with state laws. C. It sets the premiums for all reinsurance contracts issued in New Hampshire. D. It guarantees that reinsurers will pay claims to the ceding companies. Answer: B. It regulates and supervises reinsurance activities within the state to ensure compliance with state laws. Explanation: The New Hampshire Department of Insurance is responsible for regulating and overseeing insurance and reinsurance activities within the state. This includes ensuring that companies comply with state laws such as solvency and financial reporting requirements. It does not set reinsurance premiums, guarantee payment claims, or provide reinsurance directly to ceding companies. Option A, C, and D are incorrect as they do not accurately describe the department's role in reinsurance activities. Question 11. What is the primary purpose of a surplus share reinsurance arrangement? A. To share a fixed percentage of both premiums and losses for a group of policies. B. To allow the reinsurer to cover all losses above a set amount, while the ceding company retains responsibility for smaller losses. C. To transfer risk associated with large individual policies to the reinsurer. D. To provide coverage for catastrophic events that exceed a predefined loss limit. Answer: C. To transfer risk associated with large individual policies to the reinsurer. Explanation: Surplus share reinsurance involves transferring a portion of the risk from large individual policies to the reinsurer, with the reinsurer assuming responsibility for the losses exceeding a specified retention amount. This type of reinsurance focuses on large risks, unlike quota share reinsurance, which covers all policies proportionally. Option A describes quota share reinsurance, while option B refers to excessive loss reinsurance. Option D refers to non-proportional reinsurance, which focuses on catastrophic events. Question 12. Mr. James, a reinsurance manager, is deciding between purchasing facultative reinsurance or treaty reinsurance. Which of the following is the key distinction between the two? A. Facultative reinsurance involves covering all policies, while treaty reinsurance covers only large policies. B. Treaty reinsurance involves covering specific risks for each policy, while facultative reinsurance covers groups of policies. C. Facultative reinsurance is used for specific risks, while treaty reinsurance covers a portfolio of policies automatically. D. Treaty reinsurance offers higher premiums than facultative reinsurance. Answer: C. Facultative reinsurance is used for specific risks, while treaty reinsurance covers a portfolio of policies automatically. Explanation: Facultative reinsurance is negotiated for individual risks or specific policies, whereas treaty reinsurance applies to a whole portfolio of policies. Treaty reinsurance is an automatic agreement where the reinsurer agrees to cover all policies under certain conditions. Option A is incorrect as it misrepresents the scope of each type. Option B is incorrect because treaty reinsurance covers a broader scope, not specific risks. Option D is unrelated to the distinction between facultative and treaty reinsurance. Question 13. Which of the following is a key responsibility of a reinsurer under a quota share reinsurance agreement? A. To assume all premiums and losses from the ceding company. B. To share the premiums and losses with the ceding company in a fixed ratio, C. To cover only claims above a retention limit set by the ceding company, D. To pay the ceding company's operating expenses in the event of large claims. Answer: B. To share the premiums and losses with the ceding company in a fixed ratio. Explanation: in a quota share reinsurance arrangement, both the ceding company and the reinsurer share premiums and losses in a fixed, predetermined ratio. This type of proportional reinsurance is distinct from excessive loss reinsurance, where the reinsurer covers losses above a retention amount. Option A refers to a full risk transfer, not typical of quota share agreements. Option C describes non-proportional reinsurance, while option D is not part of the reinsurer's obligations under quota share. Question 14. How does a reinsurer assess the risk of a ceding company when considering a treaty reinsurance arrangement? A. By reviewing the ceding company's loss history and overall risk exposure. B. By assessing only the geographic location of the ceding company's risks. C. By evaluating the ceding company's market share and policyholder demographics. D. By analyzing the reinsurance premiums the ceding company has paid in the past. Answer A. By reviewing the ceding company's loss history and overall risk exposure. Explanation: when evaluating a treaty reinsurance arrangement, the reinsurer focuses on the ceding company's loss history, risk exposure, and underwriting performance. This helps the reinsurer understand the potential for large claims and determine appropriate terms. Option B is too narrow, as risk assessments include more than just geographic location. Option C is less relevant to assessing risk exposure compared to loss history. Option D is not a critical factor in evaluating risk. Question 15. Which of the following is the primary function of retrocession in reinsurance? A. To allow reinsurers to transfer risks to third-party insurers. B. To enable ceding companies to assume additional risks on behalf of reinsurers. C. To allow a reinsurer to share risks with another reinsurer. D. To eliminate the need for a ceding company to purchase reinsurance. Answer: C. To allow a reinsurer to share risks with another reinsurer. Explanation: retrocession is the process by which a reinsurer transfers some or all of the risks it has assumed to another reinsurer. This helps the original reinsurer manage its own risk exposure and maintain solvency. Option A is incorrect because retrocession involves reinsurers, not insurers. Option B is incorrect because retrocession is not about ceding companies assuming additional risks. Option D is also incorrect, as retrocession doesn't eliminate the need for reinsurance. Question 16. Which of the following is a common method of reinsurance pricing? A. Net present value method. B. Loss ratio method. C. Fair value method. D. Income tax method. Answer: B. Loss ratio method. Explanation: the loss ratio method is commonly used to price reinsurance contracts. It involves comparing the losses experienced by the ceding company to the premiums they receive, and it helps determine an appropriate reinsurance premium. Option A refers to a method used in investment analysis, not reinsurance. Option C is not commonly used in reinsurance pricing. Option D refers to tax considerations, not pricing. Question 17. Mr. Green, a reinsurance broker, is negotiating a reinsurance treaty for a ceding company with limited capital. Which type of reinsurance would be most suitable to provide financial stability without exceeding the company's retention limits? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Facultative reinsurance. D. Surplus share reinsurance. Answer A. Excessive loss reinsurance. Explanation: excessive loss reinsurance is most suitable for a ceding company with limited capital, as it provides protection against catastrophic losses above a retention limit. This allows the ceding company to manage its exposure without taking on excessive risk. Option B is not ideal for a company with limited capital because quota share requires the ceding company to share a fixed percentage of losses. Option C is useful for specific risks but doesn't offer automatic coverage. Option D is more suited for large policies. Question 18. What role does a financial strength rating play in the reinsurance industry? A. It determines the premiums a reinsurer can charge for its services. B. It reflects the reinsurer's ability to meet its financial obligations. C. It dictates the geographic regions a reinsurer is allowed to operate in. D. It sets the maximum amount of risk a reinsurer can assume. Answer: B. It reflects the reinsurer's ability to meet its financial obligations. Explanation: a financial strength rating (FSR) is critical for evaluating a reinsurer's ability to meet its financial obligations, particularly in the event of significant claims. It reflects the reinsurer's financial stability and solvency. Option A is incorrect because while strong FSR may influence pricing, it doesn't directly determine premiums. Option C is unrelated to the FSR, which assesses financial stability rather than geographic scope. Option D is also incorrect as FSR does not directly set risk limits. Question 19. Which of the following reinsurance contract types allows the ceding company to transfer all risks for specific policies with no coverage for policies outside the agreement? A. Quota share reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Surplus share reinsurance. Answer: B. Facultative reinsurance. Explanation: facultative reinsurance involves the ceding company transferring specific risks or individual policies to the reinsurer with no automatic coverage for other policies outside of the agreement. Option A refers to a proportional reinsurance arrangement that covers a group of policies. Option C refers to non-proportional reinsurance, which covers losses exceeding a retention limit, not individual policies. Option D is for large individual policies, but is not specific to one policy. Question 20. What is one major disadvantage of non-proportional reinsurance arrangements for ceding companies? A. They require the ceding company to share both premiums and losses in a fixed ratio. B. The reinsurer assumes responsibility for a fixed percentage of all claims. C. They do not provide coverage for losses below a certain threshold. D. They automatically cover all policies under the ceding company's portfolio. Answer: C. They do not provide coverage for losses below a certain threshold. Explanation: non-proportional reinsurance, such as excessive loss, only covers losses that exceed a certain threshold. This means the ceding company retains responsibility for losses below that threshold. Option A describes proportional reinsurance. Option B refers to a feature of proportional reinsurance. Option D is incorrect because non-proportional reinsurance only covers excess losses, not all policies. Question 21. Which of the following is an example of a non-proportional reinsurance agreement? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is a non-proportional reinsurance agreement where the reinsurer only covers losses above a specified retention amount, making it different from proportional agreements like quota share or surplus share. Question 22. In a reinsurance treaty, what is the cession in the context of the agreement? A. The portion of premiums paid by the reinsurer to the ceding company. B. The transfer of risk from the ceding company to the reinsurer. C. The agreement between two reinsurers to share the risk. D. The total amount of claims the reinsurer will cover for the ceding company. Answer: B. The transfer of risk from the ceding company to the reinsurer. Explanation: in reinsurance, cession refers to the transfer of risk from the ceding company, the insurer, to the reinsurer. This is the core concept in both facultative and treaty reinsurance agreements. Option A incorrectly describes the flow of payments. Option C refers to retrocession, which involves reinsurers transferring risk to other reinsurers. Option D is inaccurate because cession is about transferring risk, not covering claims. Question 23. Which of the following best describes a stop-loss reinsurance agreement? A. A reinsurance agreement that provides coverage for all losses above a specified amount, regardless of the loss size. B. A reinsurance agreement that reimburses the ceding company after a certain percentage of the policy portfolio's total losses has been reached. C. Reinsurance agreement that applies only to catastrophic losses and not regular claims. D. Reinsurance agreement that covers specific high-risk policies individually. Answer: B. A reinsurance agreement that reimburses the ceding company after a certain percentage of the policy portfolio's total losses has been reached. Explanation: stop-loss reinsurance provides coverage when the total claims for the ceding company exceed predetermined percentage of its premiums. The reinsurer covers the excess losses once the threshold is crossed. Option A describes excessive loss reinsurance, not stop-loss. Option C pertains to specific types of reinsurance that deal with catastrophic risks, not the stop-loss mechanism. Option D is more relevant to facultative reinsurance, which deals with individual high-risk policies. Question 24. In a reinsurance treaty, what does the term retention refer to? A. The amount of coverage the reinsurer provides above the ceding company's losses. B. The percentage of premiums the ceding company keeps before transferring risk. C. The amount of loss the ceding company retains before the reinsurer steps in. D. The amount of risk the reinsurer is willing to accept in treaty. Answer: C. The amount of loss the ceding company retains before the reinsurer steps in. Explanation: retention refers to the amount of risk or loss that the ceding company retains before the reinsurer becomes responsible for covering additional losses. This amount is set in the reinsurance treaty. Option A incorrectly describes a feature of excessive loss reinsurance. Option B describes the ceding company's share of premiums, not risk. Option D is incorrect, as retention is defined by the ceding company, not the reinsurer's willingness to accept risk. Question 25. Which type of reinsurance is most commonly used to protect a ceding company from extreme high-cost losses? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is designed to protect ceding companies from extreme high-cost losses. This non-proportional reinsurance covers losses above a specific retention amount. Option A and C refer to proportional reinsurance, which is not tailored for high-cost events. Option D refers to facultative reinsurance, which is more focused on individual policies. Question 26. What is the role of a broker in the reinsurance market? A. To underwrite risks on behalf of the ceding company. B. To negotiate and arrange reinsurance contracts between the ceding company and reinsurers. C. To provide financial guarantees to reinsurers. D. To manage claims on behalf of both the ceding company and the reinsurer. Answer: B. To negotiate and arrange reinsurance contracts between the ceding company and reinsurers. Explanation: brokers in the reinsurance market act as intermediaries, negotiating and arranging reinsurance contracts between ceding companies and reinsurers. They help match the ceding company's needs with appropriate reinsurance products. Option A is the role of an underwriter, not broker. Option C is incorrect, as brokers do not provide financial guarantees. Option D is not primary responsibility of brokers. The claims management is typically handled by the ceding company or reinsurer. Question 27. Which of the following is a key advantage of using reinsurance for a ceding company? A. It reduces the need for the ceding company to maintain reserves. B. It allows the ceding company to avoid paying claims entirely. C. It provides the ceding company with more capital to expand its business. D. It eliminates the ceding company's exposure to all losses. Answer: C. It provides the ceding company with more capital to expand its business. Explanation: reinsurance allows ceding companies to share risks, which reduces the financial burden of large claims. This enables the ceding company to free up capital, which can be used for business expansion or other investments. Option A is incorrect, because the ceding company must still maintain reserves in compliance with regulatory requirements. Option B is incorrect, because the ceding company still pays a portion of the claims, as reinsurance is not a complete loss transfer. Option D is not accurate, as reinsurance does not eliminate all exposure, but it helps manage it. Question 28. Which of the following best describes the concept of risk pooling in the context of reinsurance? A. A method where multiple reinsurers cover a single policy. B. The combining of risks from different policies or companies into a single reinsurance contract to spread the exposure. C. A mechanism where reinsurers create a shared risk pool to cover individual claims. D. A system where the ceding company shares all of its premiums with the reinsurer. Answer: B. The combining of risks from different policies or companies into a single reinsurance contract to spread the exposure. Explanation: risk pooling in reinsurance involves combining risks from various policies or companies into a single reinsurance contract. This helps spread exposure and make it easier to manage risk. Option A refers to a shared coverage agreement, not risk pooling. Option C is incorrect, because it describes shared claims coverage, not pooling. Option D does not describe risk pooling, but refers to premium sharing. Question 29. What type of reinsurance agreement is most commonly used for A portfolio of small and medium-sized risks. A. Excessive loss reinsurance. B. Quota share reinsurance. C. Surplus share reinsurance. D. Facultative reinsurance. Answer: B. Quota share reinsurance. Explanation: quota share reinsurance is often used for portfolios of small and medium-sized risks where both the ceding company and the reinsurer share premiums and losses in a fixed percentage. Option A is more suited for large catastrophic risks. Option C is used for large individual policies rather than smaller risks. Option D is more applicable to individual policies rather than portfolios. Question 30. In a reinsurance treaty, what is the role of a ceding commission? A. The amount paid by the reinsurer to the ceding company for managing claims. B. The percentage of premiums the ceding company retains before transferring risks. C. The fee paid to a broker for arranging the reinsurance contract. D. The amount the reinsurer pays to the ceding company for acquiring new policies. Answer A. The amount paid by the reinsurer to the ceding company for managing claims. Explanation: the ceding commission is a fee paid by the reinsurer to the ceding company to cover administrative expenses, including the cost of managing claims under the terms of a reinsurance treaty. Option B refers to retention, not a commission. Option C describes a broker's fee, not a ceding commission. Option D is not correct, as the ceding commission relates to managing claims and administrative tasks, not acquiring new policies.